This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stocks surge. Investors take this new phase of the trade war between the U.S. and China in stride, hoping for a quick resolution, even as big business sounds the alarm.
$1 billion tax. That's what the latest rounds of tariffs could mean for housing, resulting in higher costs and even higher home prices.
New competition. Audi is now charging up and taking on Tesla with an all-new luxury electric vehicle. Those stories and much more tonight on Nightly Business Report for this Tuesday, September the 18th.
And good evening, everyone, and welcome. Well, few predicted that the market would rally, but that's exactly what it did. Investors shrugged off the new tariffs and China's retaliatory move, at least for today. Now, some say the $200 billion in additional tariffs on imports of Chinese goods were not as bad as feared. Others say that since the new tariffs will be staggered, that gives the two countries more time to talk and potentially reach an agreement. When all was said and done, the Dow Jones Industrial Average advanced 184 points to 26,246. The Nasdaq was up 60, and the S&P 500 added 15.
But the trade war between the world's two largest economies is real. Today, the president left the door open for more talks, but he also said he is ready to escalate this fight even further if necessary.
We may make a deal at some point, but right now we just imposed $200 billion at 25%. It just went on. It actually kicks in on January 1st to 25%. It starts off at 10%, but shortly thereafter goes to 25%. And if there's a retaliation against our farmers and our industrial workers, our ranchers, if any of that goes on, we're going to kick in another $257 billion. And that'll be also at 25%, which we don't want to do, but we probably will have no choice.
Not surprisingly, China did immediately strike back, announcing billions of dollars of its own in retaliatory tariffs on more U.S. goods. Eunice Yoon picks up the story from there tonight for us from Beijing.
China has made good on its promise to hit the U.S. back with tariffs. The tariffs would cover $60 billion worth of American goods and kick in 1 minute after the U.S.'s on September 24th. Now, the number of items hasn't changed from the original list, but the rates are lower in the range of 5 to 10% to match the U.S.'s. Items that were supposed to be hit by a 25% tariff, like LNG, will now face a 10% tariff. But China said if the U.S. raises its taxes to 25%, as the White House has promised, then China will match those rates. The list includes small aircraft, drug ingredients, wheat, and LNG. The government explained its move this way. This is a forced response to U.S. unilateralism and trade protectionism. China hopes that the U.S. will stop trade frictions. There's been speculation here that the move by President Trump would kill off planned negotiations in Washington. The man who was supposed to go was the Vice Premier Liu He. Liu is the point person for China on dealing with the U.S. on trade. However, there's been a widespread feeling that this latest decision by President Trump has made it politically difficult for him to visit with the U.S. Treasury Secretary because he could potentially risk having another failure. The Wall Street Journal is now reporting that the Chinese may instead downgrade the delegation by sending the Vice Commerce Minister, who only visited D.C. a few weeks ago. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And as that trade war heats up, China's holdings of U.S. treasuries cooled off, falling to a 6-month low in July. According to the Treasury Department, China's ownership declined to $1.17 trillion. The Trump administration first activated tariffs on $34 billion of Chinese goods on July 6th. China is the largest foreign creditor to the United States.
Now, with all of this back and forth, the business community is having a hard time determining what comes next. Will this trade fight be relatively short, or will it be long and drawn out? Bob Bassani did some digging for us.
Trade tensions continue to rise, with both the U.S. and China firing a new round of salvos this week. But investors are still trying to figure out just what kind of trade war we're in exactly. The markets appear to believe that many of President Donald Trump's threats are just posturing ahead of the November midterm elections, and that the trade war will eventually dissipate, and that we'll all be back to business as usual. There's a similar optimism that spilled out from the C-suite recently. Just listen to what Apple CEO Tim Cook had to say on trade.
I'm optimistic because trade is one of those things where it's not a zero-sum game. You know, you and I can trade something and we can both win. And so I'm optimistic that the two countries will sort this out and life will go on.
But what happens if the markets come to believe that we're in a much longer-term conflict with China? Alibaba's founder, Jack Ma, said he thinks we could be underestimating the trade frictions and that it could create a mess for all sides.
This thing will last long. If you want to have a short-term solution, there's no short-term solution. China-USA trade lasts for 30, 40 years, becomes such a big size. If there's no problem, it's impossible. There's a big problem, it is very natural.
And at a Recode conference, Macy's CEO Jeff Gannett told CNBC that he expects even more tariffs to come into play, and that will start to affect apparel and department stores in a bigger way.
We do expect that, there's going to be more tariffs, and it's going to start to affect, a department store retailer more significantly because of the apparel pieces that are going to be part of it. So what I can say is that we've been working certainly with our own supply chain. We've been looking at our own private brands, and we've prepared for this.
Also, Bank of America just released a new global fund manager survey showing that trade war is still the #1 concern for investors. That's a fourth straight month. Second on the list is a China slowdown, followed by the Federal Reserve raising interest rates too quickly. One thing's very clear, the markets are not prepared for a decades-long trade war. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The CEO of FedEx also weighed in on the trade fight, making it clear he does not like it. On a conference call with analysts, Fred Smith said this is something everyone is worried about because it could potentially slow economic activity.
History is very, very clear that countries that pursue the most open markets are the ones that prosper the most and whose citizens' income increases the most. Mercantilism does not work. There's example after example of it. People that try to manage economies, particularly worldwide economies, from a centrally managed perspective cannot do so.
FedEx does not do much business with China, but the U.S.-China shipping accounts for about 2% of FedEx's total sales.
Given the enormous size of these latest tariffs at about $200 billion, some economists are now saying these will be felt directly in the wallets of consumers. Steve Leisman breaks down the potential economic impact.
Most Americans so far have been able to avoid the trade war, but maybe not anymore. The imposition by the Trump administration of $200 billion of new tariffs on China, the biggest so far, could bring the trade war home literally. About 20% of tariffs are directly on consumer goods, according to Moody's Investor Services. That includes computers, furniture, lamps, and food products. That means higher prices, and when prices rise, people tend to buy less, so growth declines. While economists debate the magnitude of the tariff impact, nearly all think it will be negative for GDP. That could be lessened if the tariffs are temporary and end up breaking down Chinese trade restrictions. Some peg the potential growth decline at just a couple points of GDP. But one forecaster said all the U.S.-Chinese tariffs combined with the Chinese retaliation could shave more than a half point off growth next year. Some even warned of recession. Moody's wrote, quote, "In stress scenarios of a material fall in asset prices and hits to confidence, recession outcomes in the U.S. are possible." But not all economists were so concerned. Wells Fargo said the U.S. economy will be able to continue weathering trade-related uncertainties so long as business investment and consumer sentiment remain positive. This outcome will be supportive of risk assets. How much it hurts depends on how fast the U.S. economy grows. If it grows at 4%, a couple tenths won't matter much. If we go back down at the prior rate of 2%, a couple tenths or a half point will matter a whole lot more. And then consumers will really feel the negative tariff effects, both in higher prices and in slower growth. For Nightly Business Report, I'm Steve Leisman.
The National Association of Manufacturers, which represents both big and small operations, wants China to end its anti-competitive behavior. But the head of the group also said he'd rather see the two sides talk and not levy tariffs.
Our issue, of course, is that tariffs drive up the cost of goods here in the United States. It drives up the cost for consumers. So for manufacturers, we want to see the administration successfully bring China back to the table for negotiations. We've been calling for a rules-based bilateral trade agreement for many months now, and we want to see that done.
Those concerns are being echoed by a major manufacturer in Huntsville, Alabama, and that is where we find Brian Sullivan tonight.
At the Polaris factory here in Huntsville, Alabama, the assembly lines are humming as production of its Ranger off-road vehicles continues nonstop. But as good as things are right now, there is concern that a trade war and its tariffs could slow things down. Because even if a company like Polaris wanted to source everything from American companies, it likely can't. Some of the steel and aluminum parts that go into each of these have to be sourced overseas. They simply aren't made here. And if those parts come from China, well, the tariffs add at least another 10% to their costs. CEO Scott Wines says that the combination of the two tariffs and domestic price increases have made things more expensive, and he's worried about the impact on sales.
Even though we source most of our components here in North America and here in the United States, we do buy a reasonable amount from China. And there is a 10% now going to 25% January 1st tariff on all the goods that we import from China. And that's driving up the cost of our vehicles and ultimately, over time, as our prices go up, reducing demand.
Any of these Rangers and other Polaris products that are sold into China are slapped with their own 40% tariff there. So Wine agrees with the president that China is not playing on a level field and a new trade deal needs to get done. He just wants it to get done quickly.
Go fast. Just get this done quickly. The opportunity for America to be better off on the other side of this is great. The impact in the short term, to Polaris specifically, is too big for me not to want this to happen really quickly. We need to get to freer and fairer trade as fast as we can.
Companies like Minnesota-based Polaris have made Alabama a manufacturing success story. But the state's manufacturing base is also home to major companies based outside of the U.S., like Mercedes, Hyundai, and Honda, who employ thousands of Alabamans, and much of what they make is sold to China. Alabama Republican Congressman Mo Brooks supports the president's agenda, but wants to make sure that his manufacturing base in Alabama stays strong.
Anything we can do to try to force more of that manufacturing in the United States of America, the more you're going to see these foreign automotive countries decide to operate and manufacture in the United States of America rather than in their home countries.
Polaris is doing what many other companies are doing to offset higher costs, eating some of them themselves, passing along others in the form of higher prices. Right now, the American economy is strong enough to withstand it. But Polaris, and no doubt other U.S. companies, are hoping that this trade fight doesn't become the very thing that slows it all down. For Nightly Business Report, I'm Brian Sullivan, Huntsville, Alabama.
Meantime, the trade talks with Canada are once again set to resume tomorrow. The two sides still appear to be far apart in some areas. And today, Canadian Prime Minister Justin Trudeau said his government will just walk away if necessary. The U.S. imposed deadline to get the deal done is now set for October 1st.
It is time to take a look at some of today's upgrades and downgrades. Facebook's price target was cut to $195 a share from $205 at J.P. Morgan. The analyst says rising expenses will reduce its earnings. The firm also lowered its earnings per share estimate for next year. The stock fell a fraction to $160.30. Walmart was given an outperform rating in new coverage at BMO Capital. The analyst cites the potential for long-term e-commerce profitability. The price target is $110. The stock rose slightly to $95.43.
United Continental was downgraded to neutral from outperform at Macquarie. The analyst there cites the stock's valuation, which is up more than 30% just since the start of the year. Price target now $95. That stock fell by 5 cents today to $90.11. Discovery was downgraded to sell from hold at Pivotal. The analyst cited the stock's 20% gain without meaningful change to fundamentals. Price target $26. That stock fell more than 1% today to $31.58.
Still ahead, does tariff trouble loom for the housing market?
Wall Street salaries have come full circle. According to a new report, compensation in the financial industry climbed more than 10% last year. The average salary and bonus is now just over $422,000. That's the highest it has been in a decade, about the time when Lehman Brothers collapsed.
McDonald's workers staged the first Me Too strike. According to workers' rights group Fight for 15, hundreds of employees held demonstrations across 10 cities. Protesters are calling for more respect in the workplace, better training, more transparency, and also accountability.
Back to trade now, aren't you glad? The housing market this time. Rising home prices and the lack of affordable housing has been an ongoing challenge for many home buyers. And as more tariffs are slapped on Chinese goods that go into the home building industry, that pain could get even worse. Diana Olick has our story.
Demand for housing is red hot, but consumers can't buy what they can't afford. Prices for new homes are especially high as builders are faced with rising costs for land, labor, and especially materials. New tariffs on Chinese goods will only make that worse. Of the 5,700 products listed in the latest tariffs from the Trump administration, a preliminary look by the NAHB found about 600 products either connected to home construction or to tools used to build apartments or homes. That represents $10 billion in goods, which at a 10% tariff rate puts a $1 billion tax on housing. This includes appliances and other kinds of home furnishing products. Homebuilder sentiment was unchanged in September on the National Association of Home Builders Index, still positive, but the builders say it could be higher if it weren't for rising costs. Taylor Morrison CEO Cheryl Palmer said those costs will inevitably be passed on to already stretched consumers.
Ultimately, we're all in the same place. We're all taking the same increases. You try to absorb it, but at some point, depending on the extent of it, yes, the consumer ultimately is going to pay for it. Our margins will go down initially, but at some point, it really depends on markets, how the consumer's feeling, all the other things.
One of those other things, rising mortgage rates. After sitting tight for several months, the average rate on the 30-year fixed is now at a 7-year high. That puts home affordability now at a decade low. And even for those who decide to stay put and remodel their current homes, the new tariffs will increase those costs as well, from kitchen cabinets to countertops to the saws and nails that put them all in place. For Nightly Business Report, I'm Diana Olick in Washington.
Sales growth disappoints at General Mills. That's where we begin tonight's market focus. The maker of Cheerios and Haagen-Dazs ice cream blamed weaker demand in the U.S. for its snacks and yogurts for its revenue miss. Margins were also pressured by a rise in freight costs. Shares finished down 7% to $44.13. Cracker Barrel said fewer customers visited its restaurants this quarter, but the ones who did spent more. But it wasn't quite enough to grow earnings at the rate that Wall Street was expecting, so the stock fell 4% to $143.80. AutoZone said it sold more car parts this summer in the Rust Belt and also saw improved performance in its commercial business. While earnings topped expectations, same-store sales rose less than expected, so shares of AutoZone were off nearly 2% to $732.76. And Visa and MasterCard have joined a number of banks in agreeing to pay more than $6 billion to settle a years-long class action lawsuit over card swipe fees. Merchant bought the class action suit against the credit card giants back in 2005, alleging the companies violated antitrust laws by forcing retailers to pay swipe fees. The settlement is the largest ever of an antitrust case. Visa shares climbed nearly 1% to $147.63. Shares of MasterCard rose more than 1% to $220.05.
The New York Post is reporting that Athena Health has now extended its deadline for receiving takeover bids after hedge fund and shareholder Elliott Management backed away from its offer to pay $160 a share for the cloud-based health technology company. But another report by CNBC says that the delay was merely because a new potential bidder has entered the picture. Shares of Athena Health fell more than 5% today to $135.27. Viking Pharmaceuticals said today its experimental liver disease treatment has performed well in a study. The small-cap biotech said the therapy was effective at lowering cholesterol levels and liver fat in patients. That news sent shares of Viking up more than 87% today to $19.46. Meanwhile, Madrigal Pharmaceuticals, which is developing a competing drug, saw its shares dive by 9% to 207.30. And the California Department of Insurance is suing AbbVie, alleging that drug maker gave illegal kickbacks to healthcare providers in exchange for prescribing the company's blockbuster arthritis treatment, Humira, which, by the way, happens to be the world's best-selling drug. The suit alleges AbbVie offered a number of incentives and free services to push that medication. The company has denied those charges. AbbVie shares fell nearly 3% today to 92.61. And medical marijuana producer Tilray said today it has received approval from the U.S. government to supply researchers at the University of California in San Diego with marijuana that will be used in a clinical trial to test its effectiveness at treating a nervous disorder. Tilray is the first Canadian company approved to import medical marijuana here into the United States. And boy, did shareholders like the news. Shares jumped nearly 29% today to close at $154.98.
President Trump is expected to head to North Carolina tomorrow to visit the areas affected by Hurricane Florence and to assess the damage. His trip comes as economists try and tally the costs, but the estimates keep changing, in part because of all the flooding and the rising rivers. Contessa Brewer is in Fayetteville, North Carolina for us tonight.
In Fayetteville, the city is now bracing for the Cape Fear River to crest.
The previous hurricane hit 58 feet. It's on track to be 61.5, so we're constantly monitoring it. We have our drones up trying to see what communities are being affected.
I want to show you the rail lines. This is a CSX rail line that runs through town, and you see all the debris that has been pushed by this raging river up against the trestle of the railroad. To give you a perspective of how high this water is, let me show you the light post that is typically on the side of the river. The river is expected to crest tonight at 59 feet right now. Flood stage starts at 42 feet. It is way, way above its flood stage, and one of the reasons why this is such a problem. Just a few minutes ago, this bridge was crowded with onlookers hoping to just see what was happening in their city and what the danger might be. Now you can see that the police officers from Fayetteville have moved everybody off. This is still a real threat to this town, and it's a situation that's playing out around North and South Carolina today as people are still trying to move supplies, resources. Those who evacuated are trying to get back to their homes, and stores and restaurants and gas stations are trying to open up.
There are not a lot of resources for businesses, and so we're thankful that the administration early on came out and gave the emergency declaration. We've been in contact with them, and so any areas that we can do to help business get up and running, we're for that.
But the flooding remains a major, major threat. We'll keep our eye on it from here in Fayetteville. I'll send it back to you in the studio.
All right, that from Contessa Brewer. Coming up, how Audi is charging up the electric car market.
The outlook for the global auto industry remains stable as sales rise in China, India, and in Europe. But Moody's suggests the threat of tariffs, rising interest rates, and higher fuel costs could hurt the industry next year. In a new report, the credit rating agency said the threat of slowing sales comes as automakers spend a lot of money on new technology and alternative fuel vehicles.
Tesla is now facing a criminal probe. The Justice Department is investigating public statements made by the company's CEO, Elon Musk, about going private. Musk, you might recall, made those comments on Twitter in early August, and when he said that he had secured funding for the deal. Carmaker has since backed off those statements and decided to not go private. But Tesla says it received a voluntary request for documents, and it is cooperating. That report sent shares down by more than 3% in today's trade.
And Tesla not only has an investigation to worry about, but now also some new competition. Audi is the latest automaker to unveil an all-electric model called the e-tron. Phil LeBeau is in San Francisco tonight, where the luxury electric car battle is heating up.
The Audi e-tron is not just another SUV. It is the latest in a wave of vehicles putting a charge into the luxury EV market.
We have created something special, truly special. Our first fully electric car the Audi e-tron.
With a range that is expected to be well over 200 miles when fully charged, the e-tron will start at just under $75,000. Pricey? Yes, but in the same ballpark as Teslas, which have become popular with high-end buyers.
Frankly, to me, it's simple. Launch a really cool car. That's what they want in the luxury market. This is a super cool car. I'm convinced we're going to see the growth there.
In fact, global sales of luxury electric vehicles are expected to skyrocket by 2025, charged up by new electric models from Jaguar, BMW, Mercedes-Benz, and others, all expected to cut into Tesla's dominance of the luxury electric vehicle market.
In a lot of ways, this increased competition for Tesla really is increased availability of models, especially models that have the same amenities or luxury offerings that are available in the Tesla products.
For the foreseeable future, Tesla will remain the leader when it comes to luxury electric vehicles. But Elon Musk knows the competition is coming. And it starts with new models like the e-tron, which goes on sale in the spring of next year. But Audi says it's already seeing strong reservations and plenty of interest for its first electric model. Phil LeBeau, Nightly Business Report, San Francisco.
And that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.